Hey traders, Jamie Setley here. It is February 18th, 2021, and we're going to take a deep dive into Eurodollar. Let's start with the weekly chart going back all the way to 2008 top. So you'll notice that the low that we had in early February was actually smack dab on top of that top side of that trend line, which connects the 2008 and 2014 highs. Okay. Now, does that mean it's just off to the races from here? I don't think so. So we're going to zoom in and take a view here. I've got to move this so that I can change the scale. All right, there we go. So we have log scale here, and if we zoom in, we can see from the March low, and we're nearing 11 months, by the way, from that low, March 23rd of last year, and we've got 5 waves up. So in Elliott, that would mean or suggest, right, that you're due for a sizable 3-wave corrective process. So with that, we'd be looking initially just as a guideline back towards, say, the 116 area, which was support for wave 4. And that would put us essentially, if we intersect the trend line off these original lows from March and April, you're looking at that point kind of into March, the back half of March, or the mid-March, I should say. And that keep that in mind, that date, because that's important. So from here, clear 3 waves down, right? Now, if we zoom in on price action from that top, we're going to get this. All right, so we've got 3 down, all right, ABC. We've got a clean 5-wave advance. Again, there's that trend line, top side of that trend line all the way back from the 2008, 2014 highs. We've got a clean 5 waves up. This video will also show the fractal nature of markets, right? That is, markets move in the same form at varying degrees of trend. So I showed you a 5-wave rally from March 2008 low, or sorry, March 2008 from March 2020 low, and now you can see 5 waves up from the February 4th low, right? 1, 2, 3, 4, 5. And we've got what we call a flat correction, which we had been anticipating after we took out the end of wave 5 or origin of wave A, and that's A, B, sharp down C, and now we could even go even shorter term if we wanted to, and you would see 5 waves up from the low yesterday. Okay, so from here on a near-term trading basis, you've got 2 levels to pay attention to, say probably over the next 1 or 2 days. That is 121.08. That's a high volume level from the breakdown, which was on Tuesday, and then support probably around 120.60. And that's where the move comes in for the next short-term trade. You probably want to look to buy into that. Tight stop under 120.20, and you're targeting 2 legs up from the low, which would be 122.20. All right, that also happens to be that high from January 13th. All right, so if we kind of, I don't have the labels on this for that, but if we think about the wave structure from the high, you got ABC 3 waves down, ABC 3 waves up. That would be your B wave of the next degree, and then you'd be looking lower again for a bigger C wave to more fully correct the big 5-wave rally from that 2020 low. All right, so there's kind of a look at Euro from a wave count standpoint. An Elliott standpoint. What I'm going to bring in as well, though, are seasonal tendencies, right? So I've always believed in a weight of evidence approach rather than just one tool. Elliott's certainly a tool, and sometimes it's not there, but when the waves are clean, we'll pay attention to them. Well, seasonality is the same way. Sometimes there are extremely strong periods of seasonality, and I don't mean directionally. I just mean, sometimes the market tends to trade in a very strong or very weak manner, right? So the next, I'd say, month is extremely strong from a seasonal perspective for the US dollar, right? That would be the inverse of euro because euro is 57% of DXY. So You can see I have this as of last Friday's close because I'm just looking at weekly closes with seasonality. This red is 30-year seasonality. Down here you've got green 5, black is 10, and magenta is 20. And the dollar over all those periods, all those look-back periods, does tend to trade higher through March 19th. Essentially, tends to trade higher through the vernal equinox, okay, which then you tend to have a bigger pivot. So this would make sense because if we go back to our euro-dollar example, where we looked at the intersection of that 116 area down here and that trend line that goes all the way back to the March-April lows from 2020, we're getting an intersection on March 16th at about 116, right? So it is possible that we, again, trade up to 122.20, say over the next, week or so, then get, a lower high within a more complex correction from that high that we had early in January, and then we have the big drop in euro in order to more fully or properly correct the huge advance that we've had over the last 11 months. So that is my view at the moment on euro. Again, for trading purposes, all you really care about, or all I really care about over the next couple days is say 120.60 or so as a possible buying opportunity, tight stop again, and then looking towards 22.20, right? And then we'll look at and look at what the market looks like when we get up to 122.20 if we get there, and see if we get any reversal evidence and reassess the situation. All right, so that's it. Again, deep dive into euro dollar here from a wave count standpoint and a seasonal standpoint. Paints an interesting picture moving forward over, say, the next month. And ideally, we have a couple good opportunities to exploit in euro US dollar. All right, take care. Bye.